A partnership is a business owned by 2 and up to a maximum of 20 people, with each partner jointly liable for business debts. A formal partnership agreement is common, but not essential in starting a partnership. However, having a formal partnership agreement can save a lot of headaches later. A strong partnership agreement addresses how decision-making power will be allocated and how disputes will be resolved. For example, a partnership agreement should spell out what happens when a partner wants to leave the partnership. State law will apply if there is nothing in the partnership agreement that lays out how to handle the separation or any other issue that arises. In a partnership, control or management of the business is shared, and its main purpose is usually to add finance and expertise to the business. It's important to note that a partnership is not a separate legal entity from the business owners. As such, all partners are liable for the debts and obligations of the business. There are 3 types of partnerships, which include general partnership, limited partnerships, and incorporated limited partnership. General partnership is where all partners are equally responsible for the management of the business, and each has unlimited liability for the debts and obligations it may incur. General partnerships are vulnerable to some of the same drawbacks as sole proprietorships, as there is no legal distinction between the general partners and the partnership itself. Meaning, creditors and lawsuit plaintiffs can reach partners' personal assets, and general partners are liable for the business conduct of all other partners. Whereas, limited partnership are made up of general partners whose liability is limited to the amount of money they have contributed to the partnership. In a limited partnership, there may be 1 or more partners who don't take part in the running of the business day-to-day and are often referred to as a silent or sleeping partner. One downside of a limited partnership is that limited partners generally don't have much say in the day-to-day running of the firm. This can be challenging for the partner who's conscious about personal liability, but also has ideas about how to run the business more effectively. Lastly, in an incorporated limited partnership, there must be at least 1 general partner with unlimited liability, and if the business cannot meet its obligations, the general partner or partners become personally liable for the shortfall. The main disadvantage of the limited liability partnership business type is that it is not available to all businesses. For example, limited liability partnership are exclusive to certain licensed professions, such as law or accounting. Overall, though, the advantages of partnerships include simple and inexpensive to establish as there are low startup costs, shared responsibility and workload as 2 or more heads are better than 1, no taxes on business profit, only on personal income, and there is an opportunity for income splitting, which can result in tax savings. Partnerships have greater access to capital, as each partner usually contributes money to start the business. Partnerships also have access to greater borrowing capacity. Banks are often more willing to lend money to partnerships than to sole proprietorships. On death of one partner, the business can keep going with the existing partners, and this is known as perpetuity. However, there are some disadvantages of partnerships, and they include unlimited liability for the business owners, as each partner is jointly liable for the partnership's debts, meaning each partner is liable for their share of the partnership debts as well as being liable for all the debts. As there is technically more than one owner of the business, there are possibilities of disputes between the business partners over decisions made, and friction among the partners of the business can be difficult to resolve in-house. It can also be difficult to find suitable partners with the correct skill set, and if partners join or leave the business, the organization will probably have to value all the partnership assets to make payouts, or business valuation for new partner buy-in, and this can be rather costly. Overall, a business partnership is a legal relationship that is most often formed by a written agreement between two or more individuals. The partners invest their money in the business, and each partner benefits from any profits and share losses made by the organization. It's important to weigh these advantages and disadvantages before deciding whether to start a business as a partnership. It's also a good idea to seek professional advice from an accountant or solicitor before making any final decisions. Thanks for watching. If you have any further questions about partnerships, please don't hesitate to reach out to us in the comments below.